Welcome to the Deep Dive, where we cut through the noise and get straight to the insights you need. Have you ever known a Freddie? You know, that friend who's always like on a diet, right?
Yeah, definitely know the type.
Meticulously counting calories in front of you. But then you find their kitchen stocked with, say, a secret stash of Snickers.
Yeah, sounds familiar.
Freddie insists he wants to be slim. But that short-term pleasure, that candy bar, it just always wins out over the long-term goal.
The immediate gratification trap.
Exactly. And Freddie is surprisingly like so many traders. They say they want to get rich, succeed in the markets.
But their actions tell a different story.
Right. They constantly self-sabotage, chasing those short-term thrills, making these reckless gambles. It's one thing to deceive others, but deceiving yourself,
That's the real killer.
as Dr. Alexander Elder, whose work we're diving into today, often implies that self-deception is truly the most challenging hurdle.
It really is.
So our mission today is to unpack the core principles for successful trading from Dr. Elder's classic Trading for a Living. This deep dive, it'll show you how to analyze markets and, crucially, how to trade them successfully, helping you recognize and navigate those challenges, both internal and external.
And that's exactly what we aim to do here. Distill that practical wisdom. We can share the knowledge, lay out the maps, show you the tools, but, ultimately, the motivation to actually apply what you learn, to integrate it, that has to come from within you.
Yeah.
Consider this your shortcut, maybe, to understanding the deeper game of trading.
Okay, let's unpack this then. Dr. Elder lays out a foundational concept right at the start. Successful trading rests on three interdependent pillars. Think of it like a chair with three legs. You remove any one of those legs.
Then down you go.
Exactly, you're going to fall, and your trading account is going to suffer big time.
It's a really powerful analogy. And those three pillars are psychology, then market analysis and trading systems, and finally, money management. What's really fascinating is how they depend on each other. Psychology, for instance, it really does come first.
You think? Oh, yeah.
Without self-discipline, no trading system, doesn't matter how brilliant it is, can actually help you. It's just like that diet we mentioned, right? It only works if you actually stick to it.
Makes sense. What about the others?
Well, then there's money management. That's completely useless if you don't have a trading system that, actually has a positive expected return. People try this at roulette tables all the time, thinking they have a money management system.
But the odds are stacked against them.
Exactly. The casino will always get the better of you because the underlying system, the game itself, has a negative expectation for the player.
Gotcha.
And finally, no trading system, no matter how good, can save you from poor money management. Just a short string of losses combined with sloppy money management, it can just wipe out your entire trading account. Poof.
Wow.
So you absolutely need all three working together in harmony.
And it's that interdependence that makes it such a solid framework, isn't it? You can't just be a genius chart reader if your head's not screwed on straight.
Or if you're betting the farm on every trade.
Precisely. It reminds us that successful trading isn't just about picking winners, it's about building that solid foundation first.
Well put.
So we've established the structure, the legs of the chair. But Dr. Elder insists the most critical element, the one that makes or breaks a trader, often lies not in the charts.
But in the mind, yeah.
This brings us right to that crucial psychological aspect, keeping your emotions in check.
And Alex Elder put it perfectly. He said, analyzing yourself may actually take as much time as analyzing the markets.
That really hits home.
It stresses the huge importance of emotional control. It's not just about numbers. It's about understanding yourself, your own biases, your fears, your greed.
And he gives some really practical advice on managing those emotions, doesn't he?
He does. 6 key points.
Okay, first, be realistic. Seriously. If you've got, say, $10,000 in your account and you're already dreaming of quitting your day job to trade full-time,
probably not the best starting point.
it's an unrealistic expectation. It'll likely just lead to taking crazy risks. Second, keep a diary of your trades.
Oh, this one's critical.
Every time you enter a trade, write down your reasons for doing it. Maybe even attach a screenshot of the chart right then.
It's essential for learning from mistakes. Otherwise, you just keep making the same ones over and over.
Third, set up your rules before entering a trade. Have your exit strategy, your stop loss, your profit target firmly in place before you get caught up in the market frenzy.
Avoids making emotional decisions in the heat of the moment. Smart.
Fourth, if you feel like you're trading too much, or maybe your results are just consistently poor, stop trading.
Just take a break.
Yeah.
Huh?
Quit for a month, even. Step back Analyze yourself. Analyze your methods. It's a pause, not a surrender. Give your head some space.
Good advice. Sometimes you need to reset.
Fifth, and this one is kind of profound, don't count money. If you catch yourself mentally converting your open paper profits into, that new car or that vacation,
Danger zone.
Elder says exit that trade immediately. That's a clear signal your emotions are driving the bus, like Freddie eyeing that Snickers instead of his long-term health.
It clouds your judgment about the trade itself.
Exactly. And finally, number 6, practice sound money management. We'll dig into this much more later, but Elder points out that simply having and following good money management rules is key to keeping your composure.
It reduces the emotional stakes of any single trade.
Right. So self-awareness isn't a one-off thing, is it?
No, absolutely not. It's a continuous process in trading. It's easy to list these rules.
But actually doing them, especially don't count money when the market's moving.
That can be incredibly hard, which, brings up an important question. Once we get our own house in order, psychologically speaking, how do we actually start understanding the markets themselves, those complex movements?
Good transition. That's where market indicators come in. They help us try and make sense of those often chaotic price charts. And Dr. Elder has this great parable for this. Imagine a man walking his dog.
Okay.
The man, right, he represents a long-term trend-following indicator. He's walking more or less in a straight line, leaving a fairly straight trail.
Got it. The underlying trend.
Exactly. But the dog is an oscillator. It's running ahead maybe to the end of its leash in one direction.
And then,
inevitably, it turns and runs back the other way, maybe crossing back past the man, always returning towards the man eventually.
That's a brilliant way to visualize it. It differentiates the indicator types so clearly.
Yeah.
So those trend-following indicators, things like moving averages, MZD, on-balance volume, they help you identify the main direction, the man's path. And generally, it pays to trade with that trend, right, in the direction the man is walking.
That's the idea.
But the oscillators like stochastics, rate of change, the force index, elder rate, they're like the dog. They help spot potential turning points.
When the dog gets too far from the man.
Exactly. When it hits the end of its leash, so to speak. With oscillators, you're often looking to trade in the opposite direction of their extreme readings, betting the dog will turn back.
Interesting.
But the main point here, and it's absolutely critical, is that there is no single one indicator to rule them all. Forget the holy grail.
Right.
Different indicators are tools for different jobs, different market conditions, and often combining them gives you a much clearer picture than relying on just one.
And Elder gives some practical rules for using them effectively, right? 3 rules of thumb.
He does. Good ones, too.
Okay, first, he argues that exponentials are better than normal averages. Why is that?
Well, it's about responsiveness. An exponential moving average, or EMA, gives more weight to the most recent price data.
So it reacts faster to changes.
Exactly. It's more sensitive to what's happening now, which can be crucial for spotting turns or confirming new trends quicker than a simple moving average, which treats all data points in the period equally.
Okay, makes sense. What's the second rule?
Watch related markets. An indicator signal becomes much more reliable if it's confirmed by a similar signal in a related market or sector.
Like your example earlier, GM and Ford.
Precisely. If GM's chart looks bullish and Ford's does too, that suggests strength in the whole auto sector, adding weight to your analysis of either stock. It's about confirmation.
And the third one, something about fishing rods.
Hey, yeah, you need a bigger fishing rod to catch bigger fish. What he means is signals on longer time frames, like weekly charts, usually lead to bigger, more significant price moves than signals on daily or, say, hourly charts.
So the bigger the time frame, the potentially bigger the move.
Generally, yes. A buy signal on a weekly chart carries more weight, suggests a more durable trend than the same signal on a 5-minute chart. Weekly beats daily, daily beats hourly.
So his advice is basically, start with a few core indicators, trend following and oscillators. Really learn them.
Understand their strengths, their weaknesses, how they interact.
And then maybe add more complexity later once you're comfortable.
Exactly. Don't try to use everything at once from day one. Master the basics first.
You often hear traders throw around sayings like, the trend is your friend, or buy low, sell high.
The classic adages.
Yeah, but they can seem contradictory, can't they? Or even contradict themselves depending on the time frame you look at.
Absolutely. The trend might be clearly up on your daily chart.
But when you zoom into an hourly chart, it looks like it's heading down.
Right. So what do you do? Which trend is your friend now? Which low do you buy?
Exactly. It gets confusing. This is where Dr. Elder's triple screen trading system comes in, right? To try and resolve these kinds of issues.
Precisely. The triple screen system is really elegant because it applies three distinct tests, like filters, to every potential trade. It forces alignment across different time frames.
Okay, so walk us through it. What's the first screen?
The first screen is the market tide. This looks at the big picture, the long-term trend. You'd use a long-term trend-following indicator on a longer time frame chart, like maybe the slope of a weekly Massey-D histogram.
So looking at the weekly chart first.
Yes. And the crucial rule here is you only consider trades in the same direction as this long-term tide. If the weekly Massey-D says the tide is rising, you only look for buying opportunities. No shorting.
Got it. So that filters out trades going against the major current. What's next?
The second screen is the market wave. Now you switch to a shorter time frame, maybe a daily chart, and you use an oscillator.
Ah, the dog on the leash again.
Exactly. You're looking for short-term pullbacks, waves going against that main tide identified by screen 1. This helps you time your entry better.
So if the tide screen 1 is up, you look for the oscillator on screen 2 to dip low.
Precisely. You might use something like a 2-day exponential moving average of the force index. When it dips low during an uptrend, identified by screen 1, that signals the dog has run away from the man and might be about to turn back. It's a potential buying zone.
Okay, tide check, wave check. What's the third screen?
The third screen is the intraday breakout. This is your actual entry trigger, looking for the small ripples that are moving in the same direction as the main tide.
So how does that work specifically for buying?
Okay, so if screen 1 says the tide is up and screen 2 shows a pullback, oscillator is low, then on screen 3, you might place a buy order just one tick above the high of the previous day.
Right.
You only actually buy if today's price hits or goes above that level. It confirms the short-term momentum is resuming in the direction of the main trend.
And where does the stop loss go?
Critically, your initial stop loss goes at the low of that previous day. Elder also mentions variations like using trailing buy stops to enter.
Which automatically follows the price up.
Sort of, yes. It's a stop order placed above the current price that trails it as it moves higher, triggering a buy if the price reverses slightly or breaks out. And similar trailing sell stops for shorting. These are more advanced entry techniques based on the same principle.
It sounds like a really disciplined, structured way to make decisions. Take some of the guesswork out.
It does. It forces you to consider multiple time frames and conditions.
But Elder also gives a really important warning about trading systems in general, doesn't he? Something about perfection.
Oh, yeah. It's a crucial point. He says, most traders take a good system and destroy it when they try to turn it into a perfect one.
Trying to tweak it constantly, chasing every little wiggle.
Exactly. They over-optimize it on past data until it looks flawless, but then it falls apart in live trading. Consistency with a good, robust system is better than chasing an imaginary perfect one.
That's a great insight.
And, if we connect this back to the bigger picture, all this market analysis, all this system building, however clever it is, it's basically meaningless without a solid approach to managing your actual capital.
The third leg of the chair.
The absolutely critical third leg, money management. Which brings us to our final pillar.
Okay.
When you're building a money management system, Elder says your priorities have to be crystal clear. Number 1, survival.
Survival first.
Number 2, steady returns. Number 3, high returns, in that order.
Not high returns first.
Absolutely not. Dr. Elder is unwavering on this. Survival comes first, always. Live to trade another day. That is the absolute guiding principle. If you blow up your account, the game is over.
So how do you ensure survival? He gives a rule for that, right? The 2% rule.
Yes, the absolute rule. Never risk more than 2% of your total account equity on any single trade.
And that 2% has to cover everything.
Everything. Broker commissions, potential slippage when you enter and when you exit. The total potential loss if your stop loss gets hit cannot exceed 2% of your capital.
Wow, 2% sounds small.
It might sound small, but it's what allows you to withstand a string of losses, which will happen without getting wiped out. It keeps you in the game.
Okay, so you need a stop loss to enforce that rule.
You absolutely must set a stop loss for every single trade to define your risk up front. And there's another critical rule about moving that stop loss.
Oh, yeah.
You may only move a stop loss in the direction of your trade. If you're long, you bought, you can only move your stop upwards, locking in profits or reducing risk. If you're short, you sold, you can only move it downwards.
So you can never move it further away from the current price to give the trade more room.
Never, ever against your trade. That's just hoping. And it violates the principle of defined risk. Moving it against the trade turns a defined risk into an undefined, potentially catastrophic one. You're protecting capital, not past mistakes or wishful thinking.
Let's walk through that example he gives just to make it super clear. Say you spot a long opportunity in a stock at $100 using the triple screen system.
Okay.
And following the method, your stop loss goes at the low of the previous day, which was, let's say, $90.
Right, so your risk per share is $10. $100 entry, $90 stop.
Okay, and your trading account has $10,000 in equity.
Right.
So the 2% rule means you can risk a maximum of
2% of $10,000, which is $200. That's the most you can lose on this single trade.
So how many shares can you actually buy?
Simple calculation. You take your allowed risk, $200, and divide it by your risk per share, $10. So $210 equals 20 shares. That's the maximum position size.
Only 20 shares.
Yeah.
Now, what if the stock drops to $95? You're down, but it hasn't hit your stop yet. Are you tempted to lower your stop from $90 down to, say, $85 to give it more room?
Ah, the temptation. But the rule is absolute.
You can't do it.
You cannot lower that stop. You can only move it up if the price moves favorably. Moving it down just increases your risk beyond the initial 2% you committed to. It's breaking your own rule.
It's like Freddie saying, oh, just one more Snickers, it won't hurt my diet that much.
Exactly. It's that immediate emotional response overriding the long-term plan for survival. That discipline with stops and position sizing is absolutely paramount.
So without that sound money management.
You're not really trading, you're gambling. Survival isn't just a priority. Elder makes it clear it's the very foundation. It's the ultimate defense against the market's randomness and, frankly, against ourselves.
Wow. What a deep dive. We've really covered a lot of ground today pulling from Dr. Elder's work.
It's dense stuff, but so fundamental.
Okay, so to quickly recap the main takeaways from trading for a living. First, those three pillars are key: psychology, analysis and systems, and money management. They all have to work together.
Can't skip any leg of the chair.
Second, keeping your emotions in check, analyzing yourself is just as vital as analyzing the market, maybe even harder. Remember Freddie.
Definitely.
Third, forget the holy grail indicator. There isn't one. Learn to use different types of indicators like trend following and oscillators for different jobs and combine them.
Use the right tool for the job.
Fourth, the triple screen system gives you a practical framework for aligning different time frames and using indicators in a disciplined way to find entries.
A structured approach.
And finally, maybe the biggest one. Money management is everything. Survival always comes first. That 2% rule, never moving, stops against you. That's non-negotiable.
Protect your capital, live to trade another day.
Absolutely. Powerful lessons.
You know, building on all this, it raises an interesting question, doesn't it? Beyond just trading, how might these core principles, self-discipline, systematic analysis, really stringent risk management, how might they apply to your personal goals, your long-term endeavors in life?
That's interesting, like in career planning. Or managing personal finances.
Or even tackling a big personal project, maybe. That need for a plan, for understanding your own tendencies, for managing setbacks without giving up. The framework Dr. Elder lays out for trading, it really seems to have surprisingly broad implications for achieving success in many areas, doesn't it? Something to think about.